Okay, let's continue on to section 4. Profitability of relative strength strategies within size and beta-based subsamples. So in this section, they're going to dive deeper into the 6-month strategy and split the subsamples into firm size as well as betas. And as far as size and betas go, they split it into 3: small, medium, and large, and low, medium, high. And so by doing so, they can see whether these abnormal relative strength profits are attributable to any particular type of stock, as well as seeing if there's a different source of the observed profits. Alright, so let's go down to table 3 where the results are displayed. Okay, so here we have a similar table to what we've seen before. If you remember, portfolio 1 was the losers, the ones with the lowest past 6 months returns, and portfolio 10 is the winners, the ones with the highest past 6-month returns. And here we have all of the stocks for each of the equally weighted portfolios. The S stands for size, so we have the smallest companies in S1 and the largest companies in S3. And here we have the betas, with the first one being the smallest betas and the third one being the largest betas. And down at the bottom we have the return of portfolio 10 minus the return of portfolio 1 in each of the categories, and F statistics and p-values. The first thing we notice is that the returns to all of the stocks in the equally weighted portfolios are approximately the same as the returns in each of the subsamples. So this 7.9 is about the same as 8.3 and so forth. 0.79 and 0.83%. And so let's go down to the portfolio 10 minus 1 section. Here you can see somewhat of a difference in the subsamples. For instance, the largest companies have a smaller difference in return than all of the companies. And the ones with the highest betas outperform those with the lowest betas. So both of these results are in line with systematic risk, assumptions, and return, and how those should play out. So even though this kind of works out in the portfolio 10 minus 1, given that it doesn't work out consistently in each of the portfolios, we could say that the relative strength profits aren't primarily due to systematic risk and return, but more to the idiosyncratic risk of individual companies and the serial correlation of their returns. And also this means that the abnormal relative strength returns aren't confined to a single subset or type of stock. So now let's take a look at panel B of the same table. So in this table, we're showing the difference between the returns of the portfolios and the market return. So this would be the excess returns over the market. And you can see as the past returns increases, the excess return increases as well. And that's across all of the portfolios. Also, we can see that the difference between portfolio 10 and portfolio 1 is mainly attributable to the winning side of the trade, because portfolio 10 and the higher portfolios have significant T statistics. However, the lower portfolios are not significant across its T statistics. And so the results here are about the same as panel A, whereas in the 10-1 portfolio, the larger companies have a smaller excess return than the small companies, and the higher beta companies have a higher excess return than the smaller beta companies. So let's go back up here to the discussion. So from a practical standpoint, we want to know, when you add in the trading costs, is it really profitable to utilize a relative strength strategy? The authors note that the turnover for using this strategy is almost 100% every 6 months. And so using a 0.5% one-way transaction cost for the trades, the risk-adjusted return from utilizing the strategy is 9.29% per year. And this is across all 3 size-based subsamples. So let's go down to section 5, subperiod analysis. And so in section 5, we're going to take a look at the seasonal effects of the relative strength performance. So let's go down to table 4, where the results are displayed. So this table reports the buy minus sell portfolios. That was portfolio 10's return minus the return of portfolio 1. And it does this for each of the months of the year. And we've got a column for all of the stocks, and then column for subsamples of size, which is the smallest companies to the largest companies. And this is from the period January 1965 to December 1989. The first thing to note is that January's returns have a negative 7% return difference between the buy portfolio and the sell portfolio, whereas the other months have positive differences. And this falls in line with other studies that say that January is a bad month for relative strength strategies. So let's go down to table 5, which has a deeper analysis of the seasonal effects. And so this table reports the percentage of months where the buy minus sell portfolio is positive. So in total, the relative strength strategy earns positive net return, abnormal returns over 67% of the months. And excluding January, it earns 71% of the months have positive returns. And in January, only 24% of the months occur where the buy portfolio's return exceeds the sell portfolio's return. And you can see, as in line with prior studies, the January abnormal relative strength returns are positively related to firm size. So larger companies do better than smaller companies. So let's go back up to table 4. So there's also seasonal effects outside of January. For instance, August returns are fairly low, and April, November, and December are fairly high. And so according to the F statistic, all of these differences are significant. So let's go back down to table 5. What's interesting to see is that 96% of the Aprils over the sample period showed positive returns of the buy minus sell. The authors find this may be due to the pension rules, where companies have to contribute money to their pensions before April 15th in order for them to get the tax reduction before for the prior year. And if the portfolio managers of the pension funds use a relative strength strategy, then this demand for those securities will increase the returns for that strategy. And similarly, in November and December, when performance is good, they may be due to window dressing or tax considerations, where the portfolio managers sell their losing companies in order to buy the winning companies, in line with the relative strength strategy. So let's go down to section 5B. So this section splits up each of the 65 to 89 period into 5-year subperiods. And the results here are documented in table 6, so let's go there. And here we have the same table as before, only the returns are split into different 5-year periods, including all of the months, just January, and excluding January, and also all of the securities, and then split into its size subsamples as before, with the smaller companies up to the larger companies. And so the results here are that the strategy results in positive returns on all of the 5-year subperiods except for the 75 to 79 period. And looking at the subsample of the size, it looks like the January returns of the small companies is the primary culprit for why these returns in 75 to 79 are so low, which shows an 11% loss versus an 8% loss versus a 3% loss as the size increases. And in each of the sizes, when January is excluded, there's always a positive difference between the buy portfolio and the sell portfolio. Okay, so let's go down to section 6. Performance of relative strength portfolios in event time. So here we're going to do an event study where we look at the portfolio returns in each of the 36 months following the portfolio formation date. And so doing so will give us additional insights into the riskiness of the strategy, as well as whether the profits are due to overreaction or underreaction to new information. And so if we find that the buy minus sell returns are significantly positive outside of the holding period, then we could infer that the reasons for these returns are either systematic risk or different tax exposures. And negative returns in the period following the holding period would indicate that the price changes during the holding period are at least partially temporary. So let's go down to table 7 where the results of this study are documented. Okay, so here we're forming the portfolios in the same way as before, where the past 6-month winners get a buy rating and the past 6-month losers get a sell, and the difference between those returns is documented here in each of the following month. And so this T column is the number of months after the portfolio formation date. So we've got 1 through 12, 13 through 24, 25 through 36, and we've got an average monthly return for each of those months and a cumulative return all the way up to 36 months after the portfolio formation date. And underneath in parentheses are the T statistics. And we see, with the exception of the first month, each of the monthly returns of the buy minus sell portfolio are positive up to through the first year. And then in year 2, every one of the months has a negative return, and then the first half of the third year, there are negative returns. And the excess is basically 0 thereafter. And the cumulative returns reach 9.5% by the end of the first year, and then drop all the way to 3.7% by the middle of the third year. And so since the high excess returns do not continue indefinitely, we would say that the relative strength strategy is not due to selecting stocks on their unconditional expected returns, for example, related to higher systematic risk. Also of note, you can see that the monthly returns in the second and third year are not statistically significant. And also, the cumulative return over the entire 3 years is not statistically significant as well. So we can't rule out the possibility that the excess returns in the entire first 12 months are entirely temporary. So one explanation that the authors propose for why the inverted U shape of returns, where the first year has high excess returns whereas the following years do not, could possibly be due to the selection of the stocks initially that are risky. However, as time goes on, the risk of those stocks diminishes. So therefore, they don't earn as high of a return going forward. So to test whether that might be a good hypothesis, the authors look at the betas of the stocks, of the buy minus sell stocks initially compared to how they end up in the end. And it turns out that the betas from beginning to end actually increase, which would be counter to what would be expected if the stocks decreased in risk. So it seems that the thought of decreasing risk causing the decrease in returns would not be the case. Okay, so let's go down to section 7, back testing the strategy. Now, if you remember, the prior tables and sections analyzed the period 1965 to 1989. However, the authors here want to go out of sample and look at the period 1927 to 1964 to see if this anomaly still occurred. So they're going to replicate the same test that they did in table 7 above, where they show the monthly returns over the next 36 months. And these are good periods to use because the 1927 to 1940 period experienced a high degree of volatility and mean reversion. So that would be counter to a momentum strategy. And 1941 to 1964 was similar to the same period of the tables and tests as above. So let's go down to table 8 to see the results of these time periods. So here's table 8, panel A, which shows the 1927 to 1940 period. And so it's the same before. We've got the monthly returns for each of the next months after the 6-month formation date, all the way to 36 months, and the cumulative return over that period as well, and the T statistics in parentheses below. So we see a lot of similarities to the prior table for the 65 to 89 period. The first month has a large negative return of 5%. But the first 12 months of the buy minus sell returns aren't as high as were in the 65 to 89 period. And then, similar to the prior table, in the next 2 years, the returns dissipate more to where by the end of the 36 months, there's a loss of 41%. And so the results here being so negative are attributed by the authors to be maybe due to 2 different reasons. One is that the volatile nature of the market at the time results in a lot of the bottom decile companies being close to bankruptcy and having very high betas and therefore earning higher returns. And also the higher instance of mean reversion from the volatility of the time period reduce the effectiveness of the persistence in returns. So now let's go down to panel B, which is the 1941 to 1964 period. If you remember, this period should be similar to the 65 to 89 period that we looked at in prior sections. And we've got the same table as before with the same structure. And so taking a look, the first month is slightly negative, as has been in all the cases. And then we've got positive returns going forward all the way through the first year, and then negative returns thereafter. And the positive returns that were earned in the first year are nearly dissipated by the end of the second year, whereas you remember in the 65 to 89 period, those returns were about 4% by the end of the third year. Okay, so let's go down to section 8. Or up to section 8. Stock returns around earnings announcement dates. So here we're going to look at information around firm-specific information. In doing so, we can find whether our results from prior tests where we found the idiosyncratic risk for individual firms and the underreaction of that information is what causes or contributes to the excess returns of the relative strength strategy. So in thinking about this, if a company has been increasing in price over the past due to good information about future returns, and if investors typically underreact to that type of information, then we would expect a big bump in price when those actual returns are released. And the opposite thing should happen for past losers, where investors had previously underreacted to how bad that is for the company, and so when the earnings are announced, the price would go down. So this time period for this study is from 1980 to 1989, and it uses quarterly return announcement data from CompuStat. And so again, they split the firms into equal weighted deciles based on their prior 6-month returns. And they look at the returns that happen around the 3 days to before the earnings release. So Table 9 reports this data. So here we have each of the next 36 months and the difference between the winners and the losers' 3-day returns at each quarterly announcement date. So these results here are similar to back in Table 7 with the past 6-month formation and the next 6-month holding period. We're here for the next 6 months after the formation date. The 3-day returns of the winners exceed the 3-day returns of the losers and are statistically significant. And also the negative returns they're going forward are consistent with the prior studies and tables in this paper. You can see here, starting around in year 2, the negative returns become statistically significant. However, the significance dissipates and the returns are closer to 0. They're going forward in the 3rd year. And this finding is consistent with Bernard and Thomas in 1990, who found returns to be significantly high a quarter after a positive earnings surprise, and for the return to be significantly negative 4 quarters after that earnings surprise. So let's sum all of this up in a conclusion. To sum this up, a strategy of buying past winners and selling past losers significantly outperforms over the period 1965 to 1989, and specifically the strategy where we use the 6-month formation period and a 6-month holding period realized an excess return of 12%. And the results of other tests showed that the excess returns are not due to just systematic risk or to lead lag effects from delayed stock price reactions to common factors. However, it is consistent with delayed price reactions to firm-specific information. And And it was found that when doing the buy minus sell strategy, the first 12 months showed positive returns. However, the next 2 years showed negative returns, which almost completely wipe out all of the gains in the first year. And periods around earnings announcement dates were also studied. And so it was found that the winner portfolios realized significantly higher returns than the loser portfolios around the quarterly earnings announcement dates in the first few months after the formation date. However, the next months were significantly negative. And so the authors suggest future studies. They note that the initial positive and then later negative relative strength returns are a little more complicated than just the common interpretation of return reversals as evidence of the overreaction and then return persistence as evidence of underreaction. So they suggest that there should be a more sophisticated model to explain why this is happening. So one interpretation is by these authors, who suggests that investors who buy past winners and sell past losers move price away from their long-run values temporarily, and this causes the prices to overreact. And it also could be possible the market underreacts to information about short-term prospects but overreacts to long-term information. And so the authors note that the evidence they gather doesn't allow them to distinguish between those two hypotheses. But they note that the results suggest that investor expectations are systematically biased, and that further research that attempts to identify explanations for these empirical regularities would be of interest.